Hey everybody, Pat Loeb, Certified Financial Planner, coming at you with another installment of our What to Know topics here. We're going to talk today about risk. Risk can take on a lot of different forms. We're going to look at it from the aspect of your insurance risk. So how do you cover yourself in the event of a loss or something devastating happens to you? You want to be protected in that event. So we're going to look at insurance. There are various types of insurance we can look at. We can look at life insurance, your home insurance, auto insurance, umbrella, which is additional liability insurance. You want to be covered if you have a boat or an RV, various items you might have. You want to make sure everything's protected. If you have individual jewelry, you might want to get an additional rider to cover that if it's worth more than about $5,000 or so. And you might have something collectible, a stamp or some coins. Make sure you have everything protected just in case of an unforeseen event. So for insurance, one of the first things we're going to look at is life insurance. And we work with a lot of Gen X and Gen Y clients. People come to us and they ask me, what type of life insurance do I need? How much insurance do I need? These are all great questions, and there's a various analysis that we have to go through to determine how much insurance you might need. So insurance, when you're younger, you're starting off, you're just beginning your career. Some of the things we see, people are just married, maybe have one or two children. You want to protect yourself in the event of one spouse or the other were to pass away early, unforeseen event. So we're going to look at life insurance, but you want to look at the different types of coverage. You could get term life or whole life. So there are two terms there that we need to familiarize ourselves with. Term life is what we usually recommend for our younger clients. There's no blanket statement. There's no one size fits all for everyone. But traditionally, we look at term life because it's a lower cost form of insurance. Whole life is going to be more expensive. It's going to be a way for you to save up. We can go over the various types of whole life in another installment, but that's a way to save up, maybe build up some cash value. You can have indexed whole life where you have investments. It acts as an investment account and as an insurance vehicle. Whole life isn't the best option for most people. You'll see a lot of insurance agents trying to sell whole life because there's a higher commission on that. I have my health and life insurance, Florida 215 health and life insurance license. I don't sell any license though because I'm a fee-only financial planner. I do not collect any commissions or sell any products. So I do not sell insurance, but I have that license to show that I'm competent and knowledgeable. And I will tell you that I know that term life fits for most people. And I will tell you honestly what I think works best for you. I'm not trying to sell you anything. I will tell you you can go out and find your own insurance agent. I have references if you need to know someone in the area that could sell you life insurance. I like to go to an independent agent. I don't like to go to someone who's captive, who's held to one company. I'm not going to use any company names here, but if you go to one company, you're not going to get the best deal traditionally to start off, and their rates are going to keep going up year after year. You're going to notice that your premiums go up, and sometimes people just forget it. Sometimes people get insurance, they leave it for years, and they forget it. I'll tell you about, I know a relative of mine that had insurance with a really good friend of theirs. It was auto insurance with one of the captive companies. Thought his friend was getting him the best deal. His friend retired, and then this relative needed to know who to talk to for insurance. So sent him to a friend who was an independent insurance agent, and when my relative received the quote, he was shocked at how much he had been paying out of pocket that was unnecessary. It was in the thousands of dollars per year that was unnecessary to pay. So we want to make sure, whenever we have insurance, we want to make sure we go out and re-quote, go out to the marketplace, get a new quote at least every 2 years. Maybe every year if you want to, but at least every 2 years. So we're going to re-quote every 2 years. Term life now, there are different terms you can go with. You can go with a 15-year, 20-year, 30-year policy. So what does that mean? That means that you're going to be covered for that term of time. So if you're covered for 15 years and you're 30 years old, you'll have a policy in force until you're 45 years old. Go to 20-year, it's in force till you're 50. A 30-year, you're in force until you're age 60. You can typically go maybe up to 65, age 70. And term life is pretty cheap because it's probably about 80 to 90% of the time the term life expires worthless, it's never used, but it's there just in case. It's there for an unforeseen event, and it's a cheap form of insurance. So we're going to do an insurance analysis when you come to us, and we're going to see how much term life you might need to protect yourself in case of an event. What do we look at there? We'll look at your income, whether you're single spouse working or dual spouse income. We'll look at your needs as far as your children's education, your mortgage, other events like that. We're going to look at what do we need to cover at a bare minimum, and where do we start? Sometimes you might need $1 million in coverage, but you're just not making, you don't have enough income yet. So we might start you out with $250,000 in coverage. Or you might have a job and they offer you some life insurance. We're going to see what that looks like. It's going to be a group life policy. We'll see what that looks like, and you can maybe supplement through your employer program as well. That may be a good option. There are good options if you've served in the armed services. We have clients who've served in the armed services. I'd like to thank them for their service right now. Always thankful for that. We can try to find you some great deals there. There are companies willing to work with you. So term life insurance. Another thing we'd like to add on to this though is I'd like to look at a long-term care rider, also known as living benefits, LB, living benefits. So that'll give you access to your policy in the event that you may have a chronic, a critical, or a terminal illness. And there are different ways the policies let you access the death benefit. But if, for example, if you have a $500,000 30-year term life policy with a living benefits rider, if you were to end up having a chronic disease, you may be able to access $50,000 to $200,000 of your death benefit. Sometimes it comes out, it just reduces the death benefit dollar for dollar. Other times it's seen as a loan, and the loan will accrue interest over time. So you have to be careful which way you're going with that, which way the company sets it up. But there are some great programs out there now. Living benefits is just a great idea for people because long-term care is, we're seeing more and more people need long-term care, whether it's for memory care, for physical needs, and your insurance typically doesn't cover that. People think if they have Medicare, they're covered. Medicare is only going to cover about 90 days, and then after that, you're on your own. So we need to make sure we're protected just in the case of an unforeseen event. Most of the time, it's not needed, but the living benefits rider on top of a typical term policy is only going to add maybe another $100 to $200 per year. As opposed to a living benefits straight up long-term care policy, that could cost you a couple $1,000s per year, and that's use it or lose it. If you have a straight long-term care policy, you would pay $2,000 for that year for your premiums. If you didn't have a need to use it, that money is gone. You start over the next year with a new policy, and the rates typically will go higher as you get older. So you want to be careful about the difference. There is, for long-term care benefits, there is a tax deduction allowed, but you must meet the 10% AGI floor. So 10% of your adjusted gross income, say you make $100,000 AGI, 10% of that would be $10,000. You can't deduct anything until you've exceeded that $10,000 floor in long-term care premiums. So it's not very useful there if you have a decent amount of income, but it is something that is available to you. Whole life, on the other hand, as we mentioned, there are different policies in whole life. You can build up cash values. You have to watch it though. I have actually interviewed with companies. I've seen companies out there. They really push whole life policies just because of the fact that the premiums are so high and they just enjoy reaping the commissions year after year. For policies that I see for people, in my opinion, might not be necessary. So if you do have a whole life policy, we'll sit down with you, we'll analyze it, we'll take a look and see if it is something that is appropriate for you to keep. If not, maybe we'll try to convert that into a term policy or figure something else out there for you. But it's just something to be careful of. When you do sit down with someone, if they're an insurance agent, just be careful what their motive is. Their motive may be to sell you something to earn a commission. And always be wary of that in any financial situation. Make sure that they have your best interests at heart. I'm a certified financial planner. We are held to the highest fiduciary standards in the industry. I must keep my clients' best interests first at all times. So make sure you find someone who has to keep your best interests first at all times when you're out there looking for insurance. So the next thing we're going to look at is auto insurance. A lot of people don't realize that financial advisors look at stuff like this. They think we just look at investments and we help you beat the market, and that's our job. My job is not to beat the market. My job is not to take too much risk. My job is to find the appropriate amount of risk for you based on your goals and circumstances. Auto insurance, you're going to want to look at what your deductible is. That's how much you would pay if there were an event, if you had an accident, how much you would have to pay. So most people, sometimes we see if people want to have a cheaper policy, they don't realize they have a $1,000 deductible in the event of an accident. $1,000 deductible, that means you're probably not going to make a lot of claims, which the insurance company likes. It will keep your premiums lower though. So maybe instead of paying, we'll say $800 every 6 months, it may drive it down to $700 every 6 months. So you might be saving a little bit of money there. The deductible though, you can bring that down to $500. Your premium might go back up a little bit, but in the event of an accident, you'll have less money that you have to come out of pocket with. So you have to look at your situation. You'd have to look at your emergency fund right there, see if you're fully funded in your emergency fund, is your debt paid off, and then we can start to look at your auto insurance and how much coverage is appropriate. You want to make sure you have the right coverage for liability. Why do we need the right amount of liability? That comes into play if we want to look at something like an umbrella policy. There's a minimum threshold of liability coverage that you need to have on your auto insurance in order to qualify for an umbrella policy. So umbrella policy is just additional liability coverage that will cover you in the event someone wants to maybe sue you. They slip and fall at your house, and maybe you have ice on your stairs, they slip and fall, or they're on your boat, or they're in your car. That will add additional coverage to your auto insurance above and beyond what your normal policy covers. So if your policy covers $300,000 in liability, and you have an accident that's, maybe there's $1 million lawsuit, if you have $1 million umbrella policy, you'll be covered. You won't have to come out of pocket with $700,000 and try to find that money. An umbrella policy also is very affordable. So a $1 million policy typically will cost you, I would guess, around $400 to $600 per year. That's just a general range. Do not quote me on that. Full disclaimer, that's not anything. We did not run any numbers for you individually. Don't try to run that as your own quote, but in a ballpark figure there, $1 million in coverage, probably worth a few $100s a month, or a year, if you can handle it, because it just gives you peace of mind that if something did happen, no one's going to sue you and take away everything that you've worked so hard for. So auto insurance, things you want to look at is your deductible, the coverage amounts you have, your liability, and then make sure you have the proper amount of liability if you want to get an umbrella policy and have additional coverage. Another thing to look at is uninsured motorists and underinsured motorists. Those are things that we may or may not have on our policy. I live in Florida. This is one of the highest states with the most uninsured drivers on the road. So you want to make sure you have some type of uninsured or underinsured motorist coverage. You can talk to your insurance agent about that as well. So we want to look at uninsured motorist. Those are two things you want to ask your insurance agent about just to make sure you're covered properly in the event of an accident. Next thing we want to look at is our homeowners policy. So you can pause this right now, go to your file cabinet or wherever you keep your policies, pull out your homeowners policy. Most of you will have an HO3 policy. Homeowners policy, the HO3 is pretty much your standard policy. You have to look and see what perils you're covered under. Make sure you're covered for everything. You're probably not covered for flood insurance. You want to see if you're in a flood zone. If you are, flood insurance is mandatory. There's a national flood insurance program where you can get flood insurance. Typical house, I'd say about $400 to $600 a year. Once again, don't quote me there. One way to drive down the cost of flood insurance, there are some homeowners policies here in Florida, where I'm located, that will add a flood insurance rider now. So you can just add, instead of going through the National Flood Insurance Program, you can get a flood rider, typically lower, typically about $250 to $350 per year. So a little bit lower. You can check your coverage. It'll usually cover about $250,000 in structure and about, I forget the coverage for personal property, but you can look that up. And if you need more above and beyond the standard personal property coverage, you can add additional coverage. So homeowners policy, make sure you have the right amount of coverage. Here again, you want to look at your deductible. The deductible, once again, is what you'd come out of pocket with if you did have a claim. You can raise your deductible to lower your annual premiums. So the higher the deductible, typically the lower your premium. So you have to look at your cash flow situation and analyze, like we said, you have your 6 months of emergency fund fully funded. So what is an emergency fund? Emergency fund would cover your 6 months of expenses. Some people say 3 months to 6 months. I err on the side of caution. I say let's have 6 months of expenses. Some people get this confused and they have 6 months of income. It's 6 months of your expenses fully funded in a liquid savings account, cash or cash equivalents. So you want to have that in cash, CDs, money market. I typically like to have at least half of it in cash. The other half can be in CDs, money market, other types of liquid investments that will mature within a year or less. Let's go to our emergency fund here. Emergency fund, we want to make sure we have 6 months of expenses covered. So make sure you have that fully funded. If you do, that's the time you can start to look and see, maybe I can raise my deductible and lower my premium. Because I have more money in the bank now, I can come out of pocket with $1,000 if there were an event rather than $500, and I'll save some money on my premiums. You're not very likely to have a claim for homeowners. If you have something that's maybe $1,000 or so, you're probably not going to file a claim for that anyway. So why have a $500 deductible? You can raise your deductible to $1,000 or even higher. Sit down, if you, like I said, if you have a captive agent, I would go sit down with an independent insurance agent. Sit down and talk to them today. Make an appointment. Go in. You might save yourselves hundreds of dollars a year, if not more. So go in at least on a semi-annual basis. Do this semi-annually. I hope I'm writing big enough for everyone in the back and everyone on camera here who's watching this on a mobile device. If not, feel free to shoot me some feedback. So make sure you make this appointment semi-annually, shop it around. Hope you save some money. Hope you've learned something today. Feel free to leave some comments. Let me know what you think of this. Let me know if there's another topic that you want to learn more about. But this is one that we see with our clients a lot, especially a lot of Gen X and Gen Y clients that are just getting started out, figuring out, do I put money in my emergency savings account? Do I start saving in my retirement account? Do I contribute to my deferred comp? Do I add on more insurance than I have at work? How much insurance do I have at work? How do I find that out? So a lot of questions that we're getting from Gen X, Gen Y clients. I'm trying to throw this out to you so you can have this information in your hands. If you're a DIY person, go ahead, tackle these one at a time. I hope it helps you save money. I hope you learn a lot. And if you have any questions, like I said, feel free to reach out. You can schedule a free consultation at the website on the screen here, or you can call my office, 239-230-0395. Thanks and have a great day.